Hi, everyone. Thanks for tuning in to another weekly market story where we summarize some sort of key financial story in 3 simple slides. I'm Dan Staus, lead wealth advisor here at Flex on Financial Management, and we'll be discussing recent events around the Fed, banks, and the economy. So specifically, the S&P 500 index last week dropped around 1.6%. After a Fed announcement, and then it kind of rebounded over the next couple of days. And that was just a good reminder that we shouldn't focus too much on the day-to-day market swings because that can be very different from one day to the next, cause us to do things that we probably shouldn't. Rather, focus on what's driving that. And so we're going to talk about that over the next couple of minutes. So the Fed announced on the 31st that they'd be holding rates steady, and that they probably wouldn't decrease or cut rates in March either. And that was a little different than what the market expected. The markets were kind of thinking that the Fed would start rate cuts earlier than later, and now it seems like it probably won't happen until later in the year. Now, rate cuts, when they do begin, will be a reversal of the rapid rate hikes that occurred beginning in 2022. So take a look at this chart. This shows the impact that higher interest rates had on banks. The line that you see kind of going up sharply towards the right side of that chart represents the 5-year Treasury rate. So you can see how it increased quite a bit in 2022. And the bar represents unrealized gains or losses from the bank. So you can see that banks showed significant unrealized losses in 2022 and 2023. And that's all because rate increases caused bond prices to fall. So many banks faced unrealized losses on their bond holdings. As the economy slowed, other cracks started to form, which led to the failures of Silicon Valley Bank, Signature Bank, and First Republic last year. And so why are we talking about all this now? Well, it's in the news again because another bank, New York Community Bank, reported a surprise loss on its earnings report. They had purchased $38 billion in assets from Signature Bank when it failed last year. So some investors are worried that this could be a repeat of the banking crisis from last year. The situation is still pretty unclear, but signs suggest that the stresses could be bank specific rather than industry wide. New York Community Bank had a large concentration of its loan portfolio in commercial real estate, which has continued to struggle. And at the moment, while the regional bank sub-industry of the S&P 500 has also struggled, the broader financial sector continues to perform well. Second chart. So this one is about unemployment and job openings. The recent jobs report showed that the underlying economy is still quite strong, and that's one of the reasons the Fed hasn't been in a hurry to cut rates. So in January, 353,000 new jobs were added, which was far above expectations. The unemployment rate remains at 3.7%, and there are still about 1.5 job openings per unemployed person. So you can see how many people are unemployed compared to how many job openings there are. So there's about 9 million job openings as of December, while there were only 6.1 million people who were unemployed. Now, this continues to be the case despite layoff announcements from large companies. One thing to bear in mind is that the layoff announcements tend to be concentrated in tech companies that expanded too quickly during and immediately after the pandemic, so it's not entirely representative of the broader jobs market. Finally, let's take a look at the VIX index. The VIX is a measure of stock market volatility, basically how big are stock market swings. Are we on a wild ride right now, like during the stock markets we saw during COVID, or is it a fairly smooth ride? As you can see from the chart, the VIX is quite low despite recent events. Still, you should always expect the unexpected. So what's the best course of action for long-term investors? Well, you've probably heard this from us before, so we probably sound like a broken record, especially if you're a client. You probably heard this 1,000 times, but don't overreact to daily headlines. Don't overreact to daily ups and downs in the market. We really believe a diversified portfolio paired with a financial plan gives you the best odds of achieving your financial goals. So We hope you found this video to be helpful. And if you're a client, thanks so much for choosing us to help with your financial decisions. To everyone else, thanks for watching.